If you owe the IRS and cannot pay the full bill, do not start by guessing at a monthly payment. Start by figuring out which IRS option fits your time, your balance, and your filing status. In 2026, many individuals can use the IRS online payment plan tool. A short-term plan can give you up to 180 days when your combined tax, penalties, and interest are under $100,000. A long-term plan can allow monthly payments when the balance is $50,000 or less. All required returns are filed, and the balance can be paid within 72 months or less. Those are screening rules, not a guarantee. The IRS still reviews your account, but knowing the difference can keep you from choosing the wrong path. Here is the first point most people miss. You should file every required return on time, even when you cannot pay. Filing and paying are separate obligations. Filing stops the late filing problem from growing, while paying what you can reduces interest and the late payment charge. Now let us separate the two common online choices. The short-term plan is for paying the balance in full within 180 days. The IRS says there is no setup fee for this option. Interest and penalties continue until the balance reaches zero. This plan makes sense when you have a realistic source of money coming soon, such as a sale, a bonus, or a temporary business recovery. The long-term plan is the monthly installment agreement. For an individual, the IRS lists $50,000 as the combined limit for tax, penalties, and interest when applying online. You also need all required returns filed. The IRS says the balance should be paid within 72 months or less. If you are a sole proprietor or independent contractor, the IRS says to apply as an individual. A business taxpayer usually needs to call the number on the notice or the business tax line. The IRS also lists a separate online long-term option for some businesses with $25,000 or less from the current and prior calendar year and a payoff period of 24 months or less. Do not apply under the wrong taxpayer category just because the online screen appears easier. Your business balance, payroll deposits, and personal income can create different filing and payment duties. If the notice is for employment tax or another business account, read the notice instructions before choosing an individual payment path. There is usually a setup fee. The IRS currently lists $22 for an online direct debit setup, $107 for phone, mail, or in-person setup, and possible waivers for low-income taxpayers. Direct debit means the agreed amount comes from your bank account automatically. The monthly plan does not freeze your balance. Interest and penalties keep accruing until you pay in full. Your future federal refunds can also be applied to the debt. That means you must keep making scheduled payments even if a refund reduces the balance. The costly mistake is choosing a payment because it sounds small, then missing it 3 months later. Suppose your hypothetical balance is $18,000. You believe you can pay $250 a month. At that rate, ignoring future interest and penalties, the principal alone would take 72 months. That is right at the IRS time limit before the balance changes. If your real budget cannot support $250 every month, the answer is not to click through and hope. Gather your income, housing, transportation, insurance, food, medical costs, debts, and account information. The IRS may ask for financial information when the standard online payment does not fit. The online tool may send you toward Form 433H, Form 433F, or Form 433B. These forms collect financial information. They are not magic forms that erase a balance. They help the IRS review what you can reasonably pay. Before you apply, sign into your IRS online account and verify the balance. Check which tax years are included. Check whether a return is missing. Then read the latest notice carefully. Write down 4 numbers before you apply: the total balance, the amount you can pay today, the amount you can pay each month after basic expenses, and the date your money actually arrives. If the proposed payment depends on overtime, a hope-for customer payment, or a sale that is not scheduled, mark that as uncertain. A plan built on uncertain money is a default risk. Also save a copy of the confirmation screen. Note the agreement type, the first payment date, the amount, and the bank account used. If you later change your payment date or bank details, save that confirmation too. The goal is a clean record showing what you requested and when. If you received a final notice of intent to levy and notice of your right to a hearing, treat that notice as a separate deadline problem. An IRS levy can legally seize property. For a bank levy, the bank generally holds the money for 21 days before sending it to the IRS. Do not assume that starting a payment plan application automatically solves every notice or every enforcement step. If a levy is causing immediate economic hardship, the IRS says a levy may be released. The facts and required process matter, so use the contact information on your notice and keep proof of every submission. There is another path for people who agree they owe the money but cannot pay while meeting basic living expenses. The IRS may place an account in currently not collectible hardship status. That status temporarily delays collection. It does not erase the debt. Interest and penalties can continue. Refunds can still be applied, and a federal tax lien may still be filed. The IRS may ask for past due returns and financial information such as Form 433A or Form 433F before making that decision. An offer in compromise is different again. It can settle a tax debt for less than the full amount when the taxpayer meets the requirements. It is not automatic, and the IRS itself warns people to be careful with aggressive companies promising to wipe out tax debt. Review the IRS eligibility information before paying anyone for application. You could also revise an existing payment plan online when the account qualifies. The IRS says taxpayers may be able to change the monthly amount, change the due date, convert to direct debit, update bank information, or reinstate after default. But do not wait for a missed payment to become a crisis. If the payment no longer fits, contact the IRS before default and ask what change is available for your account. Here is the order I would use. First, file every required return, even if you cannot pay the balance today. Second, open your IRS online account. Confirm the total balance, the tax years, and any missing returns or notices. Third, decide whether you can pay in full within 180 days. If yes, compare that short-term path with your actual cash flow. If no, look at the long-term monthly option. Fourth, calculate a payment you can maintain after basic living expenses. Do not use the number that only works in your best month. Fifth, apply to the IRS payment plan tool when you meet the online screening rules. Save the confirmation, the payment date, and the agreement terms. Sixth, if the online tool does not fit your facts, prepare the financial information the IRS requests. That may include a collection information statement. Seventh, keep filing and paying future taxes on time. A payment plan does not give permission to create a new unpaid balance. Finally, if you have a levy notice or a hearing deadline, follow that notice separately. Keep certified mail receipts, online confirmations, and a timeline of every call. The right payment plan is the one you can support and keep current. The fastest safe move is to verify the account, file what is missing, and match the IRS option to your real cash flow. If the notice involves a levy, hardship, or a balance you cannot explain, get qualified tax resolution help before the deadline passes.